Well, good afternoon, everyone. Welcome to our May edition of Market Insights. Hi, Rich. Hi, Gavin. How's everyone doing?
Hi, Todd. Doing well.
Hey,
How about
Todd.
you?
Good, good. Well, before we kick off our typical routine here, let's hear from legal and compliance. Okay. Well, spring is sprung. We're heading into mid-May here, and let's kind of kick it off the way we normally do and do a recap from what's occurred from our April session now as we get into May.
Sure. The backdrop remains pretty much the same, consistent with April. The conflict in Iran continues to kind of take center stage. Oil, remains elevated, the price of oil, relative to where it started the year. But the initial spike has not continued. And so that really matters in terms of when we think about quad two and quad three. Remember, we had kind of a short period of quad three, which is risk off. And now we're back to more of a risk on quad two. Both quad two and quad three begin from the same place, meaning inflation is accelerating. The difference is what happens with growth. And so in quad three, higher input costs like energy, the price of oil, begins to potentially have a negative impact on growth, and growth decelerates. That's in quad three. In quad two, which we're in now, growth continues to expand despite that cost pressure. And so early in the conflict, the sharp move higher in oil kind of got things across asset classes, stocks, bonds, everything, thinking about, okay, is this going to create a negative feedback loop and kind of take hold of markets? And so since the initial spike subsided and has stabilized, things have been better. And so that's kind of where we are now. I think the important part is that, like we called out early in the conflict, it's just about the duration. So it's still ongoing. It seems like things may be going better. For now, though, we can just say that the volatility in markets has come down, and we just remain vigilant and watching things as they progress.
The only thing I would add to that, if someone refers to our written market insights piece, there's a column on the asset class that has 1 to 3 month outlook. That's derived from what we call our weather model, and it looks at underlying drivers of growth, inflation, fiscal policy, monetary policy, liquidity, and positioning. That's remained positive throughout. And just as a frame of reference, the beginning of 25, that 1 to 3 month outlook went negative 2 months before markets went risk off due to Liberation Day. That also, in the middle of Liberation Day, flipped back positive. So, that's something that we pay attention to. And, currently we're still getting, a positive outlook for equities on a 1 to 3 month basis. That's about as far as we're willing to look out. But what that means is that the underlying drivers of growth, inflation, liquidity, fiscal policy, monetary policy are generating positive impulses. So, we're currently in a risk-on quad two regime, and all the data that we look at up to today suggests that it could last another 1 to 3 months.
Yeah, that's a great update. And markets have responded pretty well here the last 45 days or so. Clearly looks like markets are pointing in the right direction, and our signals caught that. So that's great. Let's transition here. We got a kind of a big week here. The Fed chair baton looks like shifting to Kevin Warsh here. I believe that'll be Friday, the 15th of May, if all goes well, and confirmation, and it looks like it's heading that direction. Give us an idea. I think a lot of people, are certainly interested in the Fed. The Fed has a big influence on, what happens. They seem to be, a focal point for not only policymakers, but investors and the public alike. So what's this new Fed chair going to look like?
Um, well, the Fed has way too big of an impact, and has had it, since the financial crisis in 2008, where they came out with quantitative easing, expand their balance sheet, and it has just become too big of, a force in markets. And if there's a positive that we could look forward to with Kevin Warsh, he's been on record saying that the Fed's balance sheet has to kind of get back down to size. Um, how far he can go, how fast he can go with it is going to be, we'll have to see. But it seems like, in order for that to happen, it's going to have to be coupled with bank deregulation, and some other, tools that either the Fed or the Treasury are going to employ. We have a massive supply-demand imbalance in the Treasury market. The Treasury just has too much debt to sell relative to the buyers out there. We've covered that in the past several times, and that's not going away. So I think there's going to be, some trade-off, and perhaps they already kind of worked it out, behind the scenes, is that, in order for Kevin Warsh to get his way, that the Fed needs to continue reducing its balance sheet, but do so in a way that doesn't, tighten liquidity in the economy. Our best guess is we're going to get bank deregulation that's going to allow banks to buy more treasuries to take up, some of this slack. We also have mentioned multiple times, last April, I think, we said something along the lines that, the only way out of this fiscal deficit is the Fed is going to have to print somehow. They're not going to call it quantitative easing. And later that year, we got the RMOP, RMOP, the Reserve Management Operating Portfolio. And again in December, we reiterated that, the Fed is going to continue to find ways, to pick up the slack. In the last quarterly refunding announcement, the Treasury, what is the TBAC acronym, Gavin? Basically, the Private Sector Advisory Committee that advises the Treasury on its plans for issuance. In the minutes of the last meeting, they talked about using the what's called the Treasury General Account. It's the Treasury's bank account at the Fed, to use some of the money to get involved directly in the repo market. So you have the RMOP that is an expansion, to the extent that the Treasury follows through on this, and rather than have their full bank account balance sitting at the Fed, they're going to use some of the excess to get involved in the repo market. Those are things that, if you're planning on shrinking the balance sheet, which is a tightening mechanism, you would want to also do some things to potentially offset that. So, this is part of the general fourth turning framework that says the deficit is too big, the amount of treasuries that the Treasury Department has to sell are too big relative to the buyers out there. And, we need to be aware that both the Treasury and the Fed are going to be looking for ways to kind of thread the needle on this. So if Warsh is serious about shrinking the Fed's footprint in the economy, we'll probably see more of these, tools, as they call them, or, facilities, as they call them, that end up being, QE, but by another name.
Right. Just Right. It's like when we went from leverage buyouts to private equity. It's the same thing, right? Just a soft. We went from junk to high yield, just a softer way
Now,
to say the same thing.
there is a difference in that QE dealt directly with long duration. And that was kind of the supercharger for markets. What they're doing now is more short duration. And that's just simply because the Treasury has figured out that if they try to finance a deficit with T-bills, that doesn't have this impact on duration. But it does have an impact, and that it can disrupt the short end, which is where this RMOP comes in, and where this potential facility to use excess TGA balance to engage in the repo market kind of comes in, so that they're not, disrupting the short end.
Well, I guess we'll see how it plays out. This has been very politically driven, as we know. The issues Powell's had with Trump, and Warsh was, Powell was appointed by Trump. That relationship dissipated, and now we'll see what happens with Kevin Warsh. So, I'm also in the process of reading the book 1929, which was kind of the infancy of the Fed, and very interesting because what you just tailed there was very similar to what people were saying in 1929, that the Fed had an over influence, and just interesting to see how you think things change a lot. Sometimes history repeats, right? So
yeah, well, don't get me started on that. They had an outsized influence within 12 months of forming the Federal Reserve.
Right.
That totally messed up the gold standard, that planted the seeds for some of the destruction that happened during the Great Depression. But that'll be maybe a topic for another
That's
time.
another story, right? Okay, guys. Well, listen, we'll see how things play out. We're firmly in quad 2, as we've discussed for the last few weeks. Who knows? We'll see what May and on into June brings. Everyone have a great afternoon.
All right, sounds good. Goodbye, everyone.
See you guys.